Hi, I'm Mal from the Money Study, bringing you another episode in our You and Your Superannuation series. This is episode number 7. This is all about the Recontribution Strategy. Ideally, we're trying to reduce tax. Should you pass away and your superannuation goes to a non-dependent. How does it work? Well, let's get our disclaimer out of the way first. There's the disclaimer. It's all about facts. It's all about figures. It's information only. This is not advice. Okay, if you pass away and your superannuation then goes to a non-dependent, so let's say an adult child, then they will indeed be paying tax on perhaps all or some of your superannuation benefit that has gone to them. If your superannuation has employer contributions or salary sacrifice, which is what we know now as concessional contributions, that money, that portion of the super that goes to a non-dependent is actually taxable. Any money that you've put in as a non-concessional is classified as a tax-free component because you've already paid tax on it. That money, if it goes to a non-dependent, will be tax-free. Now, all payments to a dependent, so your partner or a child under 18, that money is tax-free. But if this money goes to a non-dependent and there's some concessional money in there, they will indeed pay tax on it. They're effectively paying tax at 15% plus the Medicare, so 17% tax on that lump of money. So, is there anything we can do about this? Possibly. It just simply comes down to a number of factors. So what it boils down to is if you take your money out of your super at retirement, so you get to 60 plus, you've retired, you're allowed to take your money out tax-free. So if you were to take your money out tax-free, but then recontribute it back into your super fund as a personal after-tax non-concessional contribution, and it goes back into the super fund, and then you pass away and the money goes to a non-dependent, the non-dependents would actually get it tax-free, literally because it's no longer a concessional contribution, it is a non-concessional component that is now in the hands of the non-dependent, totally tax-free. So effectively what we're doing here is we're washing off that tax that would have been payable by the non-dependent. So this is quite a useful strategy for perhaps a single person who's either lost their partner or separated but do have dependent children, or they want to give some money to their nieces and nephews or the dog's home or something, and they would rather those people didn't have to pay tax on it. Well, literally what they can do is they could wash off the tax by withdrawing the money at retirement and contributing it back in again. The problem we've got are the thresholds as to how much can you put back in. Now, if you listen to our non-concessional episode there, you'll know that the most you can put back in 1 year is $110,000, or if you use the bring forward rule, 330. And so we're literally a bit hampered here. If our total super balance is say 600,000, we can't pull out 600 and then put 600 back in, the following day. If we only had less than 330, yep, we could cash it out at 60 and literally turn around and put it straight back in again as a non-concessional there, depending on what else you've done in the year. So it comes down to if you did pull out, let's say you had 600, but you pulled out 300 thinking I could put that back in, no problem at all. What happens is it comes out in proportion. So you can't just pull out the taxable bit and leave the tax-free bit. You are literally, if you had 80% of it as the taxable component, which is that concessional bit, and 20% of it was the tax-free bit coming from the non-concessionals, when you pull it out, it comes out in an 80-20 arrangement. So therefore, if you pulled out, your 500, then 400 of it would indeed be the concessional amount, but there's still that other money, which is the tax-free bit. So it means that you may not be able to get rid of all of the money, as to wash off all of the tax. Just depends on the level of what you're pulling out and what you can then put back in again. But of course, it could be a case you do this, if you capped at 330, you could put some of it back in and do some more withdrawals later on. But remembering that if you have put more money back in, you've increased that tax-free component. So when you pull it out next time, it may not be an 80-20 split, it might end up being 50-50, and so it goes on. So whether it's worthwhile doing it a second time is, it's open for conjecture, but it does come down to the numbers, comes down to, what you're allowed to do and what are the proportions between your tax-free and your taxable component. All of the components are tax-free for you. That's the key here. When you pull money out post-60, whether you've got taxable tax components or tax-free components, when you pull it out, it's all tax-free. It's just in the hands of a non-dependent that taxable component is indeed taxed. Can we do something about it? The recontribution strategy does certainly help us in that regard, but as we've just heard, there are some limitations. If it's all a bit bamboozling for you and you would just want to sit down what you can do, we can go through it with you to understand, the limitations on the strategy. Hope this helped, and we'll look forward to you joining me in another session.